Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
Cool. All right, we're running. Today I'm joined by Andrew Page of strawman.com. How are you going, Andrew?
Good, Matt. How are you?
Not too bad. A little bit sick. Claude's quite sick today, so he's not joining us, but
What's he got?
His regards. He's got COVID, man.
I'm not making fun, buddy. I know you're listening to this.
No, it's just like the worst. It's like his enemy, right? Like he's just, if there's an enemy of Claude, it is COVID, and unfortunately it has struck him once again.
It was just waiting behind a bush to get him, and it's like the second time.
He's so cautious about it. As well. Yeah, it's unfair.
Get better, man.
Yep, get better. So some good news. What have we got? Robotaxis. Michael sent this through on Twitter talking about how San Francisco is giving the go-ahead for more robotaxis in their cities. It's actually been really controversial in San Francisco, San Francisco, for anyone who's not aware, is like a failed state. It's like Gotham in like The Dark Knight Rises.
Yes,
it's like the worst. It's literally like that. It's like super wealthy. It's the wealthiest city by far in America, on average. But the average is just skewed by the tech billionaires that live there. Yeah. And then it's surrounded by just homeless,
cities,
poverty, and open crime. It's like, it's crazy. Anyway, in this context, all the robotaxis are like learning or doing their training there. And that's where it's all being led. Partly the tech thing, partly I think it's quite a slow moving city. So it's kind of like a good place where they don't crash too badly. But anyway, getting the go ahead there, which they had local opposition. There was like people putting road cones on them. Apparently that like confuses the robot and they just stop. So I don't know how that became that. But anyway, they've got the go ahead now and they're expanding operations. I did, as we talked about a couple months ago, did a robotaxi trip. I was impressed with it. I think it would be, I think it's the future. I think it'll be how we do, just how all taxis work. So
yeah,
I'm excited.
Do you remember when the e-scooters and bikes sort of, they're still around? I don't like in places like Canberra. I feel as though they've had more success than they have in Sydney around my area.
They got banned in some places, like in some cities it is banned. Yeah,
I'm not too far away from the Cooks River in Sydney, and I'd often go for a walk. There's a little park there. It's just like the canal. I call it a river. It's just a disgusting slime pit, but it's getting better. But it was just full of like e-scooters and e-bikes. It was like people would just like dump them in there. And I kind of think I'm sure a lot of clever modeling has gone into sort of, how do the economics sort of stack up and the rest of it. I don't know if people sort of factored in the throw it in the river factor. And I guess that's harder to do with like a robo-taxi, but it's also, I guess the barrier to vandalism on them is a bit lower as well. So that'll be an interesting dynamic,
And maybe more cameras to you need police enforcement and stuff.
Yeah. Or a Dark Knight.
Yeah, that's exactly what Gotham means. Or at least what they deserve.
Yep.
Yeah, just another aside on those e-scooter things. I had a mate who worked a doctor in New Zealand, and when they came out, he said it was like half of their admissions on like an Friday and Saturday evening were e-scooter, drunk people on an e-scooter that crash and just have like these horrific injuries. Oof. So it kind of put me off the e-scooter thing a bit. All right, anyway, moving on. Another bit of, this isn't really good news. I just thought it was kind of funny and science related. I guess it's good news. Scientists have used a study with monkeys to treat gene therapy to treat alcohol use disorder in monkeys. So adolescent monkeys were given free access to alcohol and couldn't get enough of the stuff, which makes them a useful model for non-human primates. Comparable to humans, I guess, when their teenagers get access to alcohol. And scientists took these monkeys, injected the brains with a harmless virus delivering neurotropic factor, a glial-derived neurotropic factor, a growth factor that prompts neurons to release the neurotransmitter dopamine, controls feelings and motivations. Doing so dramatically reduced the animal's drinking habits after alcohol was taken away and reintroduced. Raises the possibility of one day using a similar approach to treat extreme cases of alcohol misuse in people, which is good news. It's progress. And I also just thought kind of funny to imagine scientists getting a bunch of monkeys drunk.
I wonder if they had like the happy drunk and the violent drunk and like the full spectrum of different drunks within the monkey model.
Like
the
sleepy monkey.
Drunk. Yes. That's me. I'm the sleepy monkey drunk.
Horny monkey. Anyway, we'll go there. Cool. All right, that's some good news. There was some other kind of macro-y stuff. We got a lot of company stuff to get through. Just a quick one. Okay. It kind of shook markets overnight was China, which hasn't had as much focus. I guess the slowdown in China, we've talked about it a fair bit on the pod. China has, amongst other things, announced some weak data, announced they're going to stop and releasing data, which, as we know from any small cap ASX company that stops reporting a number, it's not normally a good sign. So youth unemployment in China is up over 20%, which is a pretty big deal on multiple factors because it's maybe twice as high as Australia. It's very high, but it's also just quite relevant to China as like a regime where you don't want young unemployed people, the kind of people that protest in the streets. So anyway, China, the news overnight was China cut one of the key interest rates to try and stimulate growth, which kind of showed that, they're gripping with deflation, an economy slowing, property market slump, potential kind of shadow bank crisis. So basically a lot of stuff going really bad in China. And I guess the markets just overnight all reacted to that, down about 1% or so in a lot of indices.
I mean, it was interesting too, because like so much hope is probably the best word was placed in the reopening of China, because China obviously had a lot more stringent lockdowns. It is a big player on the global stage. It was like, well, when China reopens, I mean, things are really crappy in the West, but when China reopens, it's going to stimulate a bunch of demand. And it's kind of like, it doesn't really happen so far. I think a lot of that shadow banking stuff feels like it's been papered over because there's just sort of basic maths at play here. And it's kind of like, well, none of those has gone away, right? So it's interesting. And it's just, then there's just the very opaque nature of the data that sort of comes out there that you can only guess. And it's I get to a point where my natural inclination is to go to the hyper bearish. I don't know why I do that. I just do. But then I've got to pull myself back from that because it's not based in reason. It's just, I don't know what it's based on a doomer mentality. But at the same time, it feels as though there are some pretty interesting structural issues there.
Yeah, it's a weird one, man, because you can kind of look at the structural stuff and it's just been there for a long time as well. Yeah. So like a lot of the structural stuff you could look at like 8 years ago when, I went to China, met with Michael Pettis amongst others. And it was just like a lot of the talk then was that, we were hitting the edge of the limit of what they could do with this growth model. And they've just kept it going for like another 8 years. And everything's it didn't really get repaired. Like all the, things that were unsustainable just grew. Right. Yeah. Like the amount of debt, blah, 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 debt fueled growth, like way too over investing in CapEx and not enough
ghost cities and
like
railway lines and highways to nowhere. And
exactly. It didn't really get better. It just didn't. There was no blow up, I guess. And that's something that is different in China. It's not like a market economy. So there's differences. But maybe we're reaching a point where it's starting to hit a limit. I don't know.
Well, that's what I think that's the refrain that everyone says. Well, it's a command economy, but and it's not physics, right? Like you can't go faster than the speed up. There's not these hard limits, but there are certain factors that, as closest to that kind of thing that you can get. I mean, at a point there is a reckoning that needs to be happened. I wonder if it's just a question of it hasn't happened yet, therefore, okay, fine, it never's going to happen, or just hasn't happened yet. I mean, back to the monkeys and the alcohol, right? It's just like you can, we all know of someone who's probably slowly drinking themselves to death, and you sort of look at them and go, wow, this is not going to end well. Like 8 years later, they're still sort of somehow functioning. It's like, it's not a great situation.
No, it's not a great situation. I do think, I would still be as cautious as I had been, but I've been thinking that for quite a while. So I guess we'll see. One that we'll track over the next few months. I think there's not a lot of people who, I guess a lot of people who'd been bearish China had just been bearish so long, people forgot about it, right? Like it didn't work, it's like, and so I think that maybe it's coming back onto the radar a bit now, but we'll see what happens over the next few months.
And I guess just on that reckoning, if potential, it's, the way that it needs to sort of play out is that there has there has to be some kind of default at some level, whether it's a hard or soft or an implied or direct sort of default on money that has been lent out unproductively and will not be repaid. I mean, someone's holding a bag somewhere.
Yeah.
many bags in many parts. And that's, again, I'm not saying it's the end of the world, but it's just like someone's got to wear a loss here, right? Like you can't throw money at bad projects. I mean, let's bring it back to first principles here. It's like, hey, Matt, give me some money. I want to start a business. Like, okay, cool. I'll do that. And I go and decide that I want to do some stupid thing and I torch all your money. Like,
yeah.
I can't just print up more money and give it. Well, I guess maybe in a government sense, I could print up some money and give it to you.
It's the real return. It's productivity that disappears, right? Over time, that your investment becomes less and less productive, and that's the real world thing. And it gets confused because in finance, whatever news, we always talk about GDP in the short term. So it's like this idea like an earthquake is good for GDP because you go out and have to do a lot of rebuilding, right? And it's like obviously, like any person on the street could tell you, it's obviously not a good thing, right? You've just destroyed a bunch of productive capacity. But in the short term, it looks like a good thing. And so, that's kind of the potential thing that we're hitting here is like there's been massive overbuilding in property and infrastructure. And now you don't need to do that. And I guess who gets affected? The other weird thing with China is the debt isn't held by the central government. The central government debt to GDP is always super low. They keep their balance sheet like pristine, and it's all kind of pushed out to local governments. Yes. And so local governments are kind of instructed to take on the debt or incentivize all these different carrots and sticks to do it. And the idea then is that central government could always act as they're always super strong so that they kind of guarantee the whole system. But if I guess the risk would be more like a malaise, right? It just becomes this, all the local governments just kind of weighed down with debt and unproductive investments. You're not able to keep selling land anymore, so that like major income source is gone. That's probably the risk. I think there's been some talk of it like from geopolitical perspective, China being way more dangerous in this mode because there would be an easy way to get everyone 20% youth employed is, building tanks or something. So there's like a risk of that. I think that's fair. Like leaving that aside, I do think that's where you start hitting limits, but we'll see what happens. There's a book, a most recent one I read, I've read several on China, was China, the Bubble That Never Pops, which I just think it sums it up. Like
great title.
Yeah. Cool. All right, let's go to some local news maybe.
Yeah.
What have we got? We got heaps of stuff. Maybe keeping Macquarie themed. JB Hi-Fi numbers were pretty good. Scali was also surprisingly good. Did you have any thought on some of the retail results that we'd had out over the last few days, Andrew?
Yeah, I thought JB Hi-Fi was pretty good. Total sales were up over 4%, which is pretty decent. I mean, net profit was down almost 4% and earnings per share was essentially flat, although a record result, it was up 0.1%, but hey, it counts. And look, that's nothing to sort of like do cartwheels over, but I think in the context of expectations, it ain't half bad. And don't forget, we're cycling off a period where we're all, decking out our home offices and working from home. And it was, JB Hi-Fi did really well on the back of that. And it just feels as though, that wasn't as bad as a lot of us thought. The balance sheet is in insanely good health, huge amount of cash there, not much debt. It just always gets talked about as one of like the standout retailers in the country. So Nick Scali, we've mentioned, I think JB Hi-Fi is up there. Bunnings is definitely up there.
Bunnings, Bunnings is like an institution. I think now that, particularly now that I have kids, like it's like a thing. You know what I mean?
It is a thing, and it's I'm not a big DIYer, but every time I go there, it's just pumping, right? Like it is always pumping. And actually, I'll say the same with JB, right? Like every time I walk past that, I have to say, back in how long ago? 5-10 years ago, I was quite bearish on JB because you'd sort of go in there and they'd have all these shelves of DVDs and games. Like, who the hell's buying a DVD? Like, it's people still like now in 2023 is like a DVD. Like, it's like selling cassettes or something. Maybe records I can get because LPs have got some kitsch value to it, and like the audio files will go, oh no, it's such a better quality or whatever. But like, you're buying a Steven Seagal DVD for $23. Like, I think basically what it is like grandma's going, well, I wonder what little Timmy would like. And this looks good.
But I don't think it's not a big part of their sales these days, right? They've just pivoted into other things. But it's
a reasonable amount of floor space. It's not it's not an insignificant amount. Anyway, it's
definitely presence. That's like a gift.
Yes.
Like no one
From
goes out and
grandma.
buys. Yeah. A gift from grandma. That's definitely a gift from grandma.
There's this artist called Elvis that I thought you'd like. He
Thanks for
seems
this
to be up
movie
and
that's
coming.
also on Netflix and several other streaming platforms.
And I've just like got 500
This would be a less
perfectly decent
convenient way to
pirated
watch
copies.
it. Yeah.
Like, Nana, I don't have a DVD player anymore. But they
execute
evolved.
really well. Really good
Yeah.
culture, really tight. Like all their operating metrics are always
100%.
better than others. The other thing with them is Amazon. That's kind of the threat that I'd been more concerned about because Amazon launched into Australia and it eats electronics market share. Like in the US, I think it's like over 50% of all online electronics is Amazon. Like it's kind of crazy.
Yeah.
Like if you think about that.
Wow.
Yeah, and so they're still way smaller here though. So JB Hi, like just the amount Amazon's growing is much smaller in dollar terms than JB Hi-Fi grows each year. So like I don't think they're losing that much share to them. Maybe I don't know. It's hard to know. We don't have exact numbers on Amazon, but that was kind of the other risk I have is like for a lot of electronics, I would just buy instantly from Amazon. I'm kind of like a big Amazon Prime user as well. So like there's a certain threshold where I just use Amazon because it's like magically arrives at my door, a day later or whatever. Yeah. So I mean, I still think that's probably the bigger bear case for me longer term is Amazon, particularly the fact that I don't see a lot of other retailers investing in the fast shipping that they're doing. I read another interesting thing. In the US, they're down to like a few hours shipping. And a few hours kind of, like even 1 hour shipping for like a lot of stuff. And so a 1 hour, like that changes the game pretty dramatically, right? Like, especially when we're all like, none of us have patience anymore. We're all super short term, whatever. If you can get something in an hour, even 4 hours, like it's pretty rapid.
I'm impressed with the next day, frankly. Like, I'm
like it's
impressed
way more convenient than going to a shop. Like for a lot of stuff. And electronics, you don't need to try out as much. So that's still a bigger, longer term bearish thing I'd have a concern with. But in the meantime, hey, they're doing really well in this, environment that should be really tough. And so, it's kind of there's a few ones like, and Nick Scali, you'd kind of think should be really hurt by the property slowdown, less renovations and still kind of holding their own. They are more cautious. Nick Scali, so kind of leading it out there. But
did we mention this last week? I mean, the thing when you look at the analyst guidance and, take that with a grain of salt, but there's like pretty substantial drops in NPAT expected for the current year, like 30%, 35% kind of ballpark. And you think, gosh, that's pretty severe. So the point to note here is there's a reasonable amount of operating leverage. So I think you get, I tried to do some really rough maths, but it was like, 10, 15% drop in top line will get you that kind of fall. You sort of hold fixed costs steady and apply the same gross margin. But I think, and again, sorry if I'm repeating myself, but the market is not expecting that, right? And so JB, last I looked earlier this week, it was on a yield of 6.5% fully franked and on a PE of 10. And so you go, okay, well, let's say that NPAT or EPS drops 35%. It doesn't push it up too high, right? And it might be too, like historically, these retailers they don't often trade at PEs of 18, right? So 15 sort of upper end for these kind of guys. But if you're at the upper end, bottom of the cycle, assuming that's what your view is, the conversation that sort of happened amongst a few members on Strawman has essentially been that there's a time arbitrage here. If you're someone who's able to sort of look 3-4 years out, okay, it'll be a crappy year, maybe this year, maybe the year after that. But at some point, if you just say, look, I don't know, in the year 2026, EPS are pretty much back to where they were in FY22, FY23, and they're at a PE of 12, and I've gotten a pretty decent dividend along the way. Actually, the maths works out that you actually get a fairly decent return.
Yeah, I think that's a good call. Like, not necessarily saying that is the case here, but that's definitely the way that an investor can play it. And the thing that you have to keep in mind, though, is you do have to the reason people don't want to own it now is they have to own it as the share price falls, typically, right? Like,
that's the hard part.
That's the cost. It's still going to trade on. It'll trade on less than 10 times probably if you head into a recession and say profits fall 30%. That means your share price falls 30% at least, but probably more because the multiple probably comes off a bit more, and then you're kind of down there waiting, like, it's easy to say time arbitrage. The hard part is holding, knowing that it's going to fall, and that's what puts people off it. Like they just like, I'll just wait until the bottom, and then of course that's how you miss it as well. But so I think that's the trade-off. It's an interesting.
I find the game theory super interesting around it because I got nothing to back this up, but I bet if you were to speak to all the retail analysts that cover it, they would go, oh yeah, that's exactly what's going to happen. But I don't want to hold it.
Yeah.
Everyone's looking at what it's the Keynesian beauty contest writ
Yeah.
large. It's exactly what it is. And I feel as though if you do have this, a decent amount of fortitude and a decent time horizon, there's something to be said for that. Having said all of that, I haven't bought any, right? I don't have a lot of cash lying around is my main problem. But yeah, anyway, it's an interesting setup. Oh, actually, and the other thing that's worth pointing out too is with JB is that, I don't know, shares are what, 10, 12, I've got to look it up now, but they're not far off record all-time highs.
Yeah.
Anyway, right?
Yeah, fair point.
It's interesting.
Yeah.
We should move on though.
Yeah. Some other good news. Well, actually related to those, Tempo and Webster sales were up in July. They had a down year, which they've kind of flagged. And yeah, they kind of gave some success to AI helping to write descriptions of things that they're selling, that they're using ChatGPT for interactions.
They just wanted to find a way to put AI into the release. 100%.
But another one that kind of surprised me in that it's still kind of chugging along, considering how much we know that renovations are dropping off and that everyone maybe bought a lot of furniture during COVID. So yeah, maybe just a quick one there. Do you want to cover Stealth Global? So maybe it was the caveat for this one. You do own it, and it is super liquid nanocap. So I'll try and find some pretty negative things to say about it. But yeah, this is not a endorsement to buy. But yeah, it had some good results though at the same time. What were your thoughts?
Yeah, tentatively good results. I mean, the revenue growth wasn't as high as I think I would have liked. The margins improved, which is, I mean, the thesis here is that they will see margins trend more towards what US peers have done. And Mike Arnold, the CEO, has basically sort of said, we think we can do 200 million in revenue, 8% EBITDA margin. And the EBITDA margin at the moment is 4.7%. So that could double on some reasonable top line growth. So the thesis for me has always been, well, actually, you can reasonably short of those targets. I mean, you still got to move in the right direction, but it's at a pretty low multiple, and probably because it's a bit of a lobster trap because it's so hyper illiquid, et cetera, et cetera. So I don't want to sort of promote this as anything that's like a slam dunk. And they've released. They had basically a one pager. We haven't seen the full set of accounts yet. And there's questions that are outstanding here. But there's a business that in FY23, we saw revenue 11% higher, 17% if you look at just continuing customers. They've compounded the top line at 29% CAGR over the last 3 years. EBITDA was up 32%, NPAT was up 50%, very low base, mind you. And interestingly enough, free cash flow was over $5 million, $5.6 million, right? The market cap here is 12 million. I often joke, it's like I could buy like 2 houses in Coogee on a 1% net yield, or I could buy something like this. They're on track to pay a dividend as well. I don't think they should. But
what's the concern in the market? Is it just like industrial stuff slowing and so like not good into a recession? Is that the main thing?
No one's looking at it. It'll be a gradually and suddenly kind of thing if it ever does sort of re-rate, and that could take a couple of years. I think they make this claim that 95% of their revenue is non-discretionary.
Yeah.
Right. And I get where they're coming from. In other words, if you're in mining is a big part of it, construction or these kinds of things, and you've got operations, you need the high vis vest, you need the belt sanders, you need there's thousands of SKUs that they do. So you need it, right? It's like, I'm not going to not use this. At the same time, your customers may slow down, and so it's not non-discretionary in that kind of sense. So I think there's some subtlety there, and they're maybe being a little bit clever with how they're saying that. I've tended to take the view, and I don't know how confident I am on this, that even if there was some macro headwinds, that the government is likely to instigate a bunch of infrastructure programs and that kind of stuff. There's probably some benefit that they would get for that. And we're also seeing lots of activity around sort of lithium and new materials. I don't know. I feel as though they're pretty okay. They've got a roll-up strategy in a very fragmented market, but one that they've done, I think, with a fair degree of discipline. They paid down a bunch of debt. I'll give them credit for this. I'm spending way too much time on Stealth, so apologies. So the last thing I'll say is that they used debt to fund some recent acquisitions and not equity. And I think given where the multiple and share price was and where the interest rate that they were available, which, they're not they're not paying 1 or 2%. It's much higher for these guys given their scale and the rest of it. But I think she think it was very prudent, and they're paying that down pretty rapidly as well. So I feel as though decent execution, decent opportunity. It's just going to be a very slow burn. And yeah, that's all I'll say.
Yep, fair enough. Another one, some good news. Family Zone, now called Qoria, reached 100 million of ARR. So that's pretty good news. It was not a huge step up. They were at 97 million as of June 30. So the next update was for July, which I guess in one way you're like, you could probably like infer that you're going to hit 100, like
right.
But I guess they've done it kind of quickly, potentially. If it's come through in July, it's only a month later. I'm not sure how high quality their numbers on ARR are, but yeah, a small token of good news, I guess. In the meantime, company hitting a pretty big ARR number, assuming it's all legit ARR, not pumped anyway. So yeah, pretty good.
I love that. Yeah, that's good news.
We chatted about Family Zone Cyber a fair bit in other episodes. Wants to tune into those, get a bit of that stuff. What else is going on? Well, Kelly Partners announced a strategic review, which I thought was kind of interesting and got a bit of a buzz on Twitter. Kelly Partners it's I guess you'd say like a roll-up of accounting firms.
Exactly what it is. Yep.
Yeah, so buys a lot of different accounting things, brings them under the Kelly Partners brand. And as we discussed before, got like a real global reach. Something about it resonated. I don't know if it kind of rode a bit of the investor cycle in like 2020-ish times, but yeah, it kind of like it put out a message of being like we're similar to Berkshire Hathaway, I guess would be the way that I'd sum it up. And just kind of resonated with a lot of these global investors looking for another mini Berkshire Hathaway. And they kind of leaned into it a fair bit. I think I might have teased a bit, and the CEO kind of said in the FR thing, I want to be known as the Buffett of Australia or something, which I think is a risky thing to challenge the gods to curse you with.
Well, Lawrence Cunningham is on the board.
Well, that's the next thing, isn't it? So Lawrence Cunningham, so he's the author of, several books, I think, about Buffett. Interesting guy, a very well-respected guy to have joined the board.
And well, especially when you're like listed on the other side of the world. And I think when he joined, it was like 150 million market cap. He's like, what? I imagine he could, maybe, I'm sure he's on several boards, but I imagine he could, he's not doing it for the prestige, I imagine. Yeah. So I don't know what Brett Kelly's had to sort of pull to sort of convince him to come across, other than perhaps the merits of the opportunity itself. But it is, I actually bought some at, I want to say at 85 cents. I'd have to check it, thinking, it was just super cheap. It was super cheap. And then I kind of thought, but ever got to sort of like, $1.10, something like, I forget now. I was like, I'll take the money. And of course, the gods do what they do. And it's like $4.50 or something now. I got to above $5. But
yeah. The news now is that they're potentially doing a strategic review to look at options for realizing shareholder value, which could mean like taking the company private or selling it, basically feeling that the shares are now undervalued in their eyes. Yeah, I don't know. It was an interesting one. It caught a bit of attention. I mean, on one side, potentially good if you can increase value of the shares. The other is that it does trade on a fairly high multiple.
47, I just checked.
Yeah. Is that something that would normally get taken private? Take privates are normally at like very low multiples or something that stumbled. Yeah, do you have any thoughts on that type of strategic review? Maybe broadly, if not KPG?
There are certain heuristics that you got to be careful with, because there's always many, many exceptions to the rule. But I joked to you the other day, we'll get to Pointerra in a minute, but I kind of thought anything listed in Perth is a red flag. Apologies to all our Western listeners, but I mean, I'm joking a little bit.
Half
joking. The other one is whenever you hear the word strategic review, run. Like it's never good, right? Like it's never, ever
I guess
good.
This is slightly different because it's not like we're bringing in the consultants to figure out what our strategy should be. Yeah. This is more like, should we sell? But yeah, I get what you're saying. I think that it's definitely gives pause when you hear that one.
I mean, look, I think we've spoken to Brett Strawman, and he's been everywhere. So he's made some really good points. I mean, you want to talk about non-discretionary sectors, recession-proof sectors, accountancy firms, right? Like they are super robust. They've got big opportunity, like roll-ups. Look, here's another heuristic: stay away from roll-ups, right? I just mentioned that with Stealth, and which is also Perth-based, right? So, like, again, I'm breaking all
roll up. Really?
Yeah.
Actually, I'm just reading this news. Stealth announces strategic review.
Oh God, here we go, trifecta.
It's not real, guys.
But you know what I mean. And so anyway, but they have, I think they have executed really well, and there's a generational thing there. So, like, someone who's run a practice for quite a while, and there's no obvious successor. And this is like the value prop from Kelly Partners is, well, we will respect your legacy and we'll run your enterprise rather than giving it to your idiot son who's going to like do coke in the bathroom and sort of, what was the movie? Horrible Bosses kind of style, Donald Sutherland's kid, whatever. That was a great movie. Anyway.
Yeah. So that's the value prop. It's like,
so, and I think they'll do it. And they've got really good, decent growth. And I mean, look, so I think I'm just going off assumptions here, but 16 cents earnings per share, 2023 is the estimate, up to 23 cents in 2025. That's decent growth. There's nothing wrong with that. But it's kind of like, well, even if that's true, let's call it 25 cents that they do then. And let's say that they're on a P of 25. Say they're on a P of 15 or something at that point, which is probably more in line with what a company like this would normally on average trade it through the cycle. It's sort of like sub $4. So I feel as though, anyway, I would love to understand where they feel as though the value is not being recognized. We could argue like degrees and maybe it's like a little bit undervalued, but is it screamingly, insanely so cheap that you need to have such a radical rethink? I don't know.
No, that makes sense. Well, you mentioned Western Australia listed companies. I think we have to cover off Pointerra's announcement that they will be doing a capital raise. The last announcement, we kind of talked about this recently on the pod, but the last deck from them had on one of the slides, Pointerra's self-funding growth strategy, which does seem to, I don't know.
I don't know what you mean by self-funding.
I mean, you will fund myself. You give me money to fund myself. Yeah.
And the other thing that's got to stick in your craw is like we talked about it at the time. There was this ostensibly really positive announcement with some utilities companies over in the US. Again, reasonably vague, but very blue sky. And like shares went from like sub 10 cents. They're up
almost 100% at one stage. On the day.
In fact, I think they closed, well, what was it? Thursday, the 27th of July, 9.5 cents. 28th of July closed at 20.5 cents.
There you
go. So down at 13 cents. So I was like, but okay. I think a couple of people might have said on Twitter and elsewhere that this probably means a capital raise, right? You're getting the share price up, getting ready for it. So I think it's sort of like I've sold down rather heavily. I really like the tech. I love the opportunity. I was a real sort of believer in it, but it's just sort of like, fool me 12 times, shame on you. Fool me 13 times, I don't know. Am I being too harsh?
I don't know. Yeah, I guess you need to see what happens. Well, it'll depend what happens from here, I guess. There's definitely been a few things that were not ideal from, talking about ARR and seeing it flow through in cash and a few other metrics that kind of moved right over time. And yeah, I don't know. It does annoy me, the self-funding type talk, which I've seen before. I think I mentioned it on the last pod where I've even had a company say that they don't need to raise capital in the meeting where they're raising capital. Like we're meeting with people to talk about raising capital. And I'm like, so when we last met, you said you didn't need to raise funds. And they're like, yeah, we don't need to raise funds. It's like, you're raising funds. Like, how do those things go? And this wasn't Pointerra, it was another business. But yeah, that does annoy me a little. I guess what would it take from what it needs to happen from here? So what would you hope that they raise, I guess, a lot and don't need to raise again and then just start, turning it into contracts and cash flow?
I'll be generous here. So we don't know what the raise is for. All we've seen is the ASX announcement, which is said we're going into pause. And then you see the attachment from the company secretary of Pointerra, who just says it's in relation to a pending announcement, regarding a capital raise. Maybe there's some like awesome acquisition that they're picking up for like, 1 times EBITDA. It's going to like bolt on this incredible technology and expand them into these really lucrative markets. God, I'm really reaching at this point. So we don't know, right? So it maybe that I would look on, depending on the nature of a potential acquisition, I would look on that very differently as I would to, oh no, we just need some cash because otherwise we're insolvent, particularly in light of recent comments. Now, look, even people in the hot chair who's steering the ship don't know what the future brings, and they can give honest hand on heart expectations, and business is hard and things change around. So I'm not going to be overly critical of things that may have been said 6 to 12 months ago, and the world just hasn't evolved in the way that they expected, especially if they're honest and candid about that. But when you say it literally weeks before, and now you're saying this, and now this is just for working capital purposes, it's a big red cross. As is, and the other thing which we've talked about a lot of as well is they just stopped reporting ACV. Every announcement, ACV, and no, actually we're not going to do it. And it's a real, it's like China are not reporting youth unemployment anymore. It's like, whoa, why? I mean, I can't imagine you've decided not to because the figures are just so good that you don't want to report them anymore. So there's kind of a death of a thousand cuts sort of phenomena here. Like I as I say, fool me a few times, okay, I'll be a bit sanguine about it. But at a point, you kind of think it's on you, all right? And maybe this is the wrong point of capitulation and I'll look back in years to come and go, oh man, I can't believe I was saying this when it was at 13 cents and now it's $1.30. But it doesn't look good. I think we can all agree on that.
No, I think that's fair. We'll see what happens when it actually comes out. We don't know what the raise is yet. Maybe we'll have an update on it in a few weeks or months. We'll see what's going on.
We have to talk about another show favorite. And Claude's not here, and if he was here, he would do it far more justice than we.
Yeah, well, let's maybe wrap with that one. So Claude wrote a good article on this. We're talking about Pro Medicus. So if you want to check it out, he's not here, on arichlife.com.au. Do you want to
somewhere he just got like a cold shiver down his spine. It's like...
Do you want to just give us a headline?
Oh man, what an incredible business. Like, so let's put the share price aside for a second. We'll come back to that. But I mean, just an insane, like, I mean, without hubris, I will say top 10 business on the ASX, maybe top 5. Like in terms of self-funded, this is self-funded, right? Like their share count's gone down, in fact, over the years, I believe. At the very least, it's flat when you sort of do the buybacks offset with some employee shares. But they have continued to grow at an insane rate. Revenue was up 33.6%. Net profit was up a bit more at 36.5%. You know, the cash pile jumped up to over $120 million. It was a 34% increase, completely debt-free, fully franked dividends, just like win. They just can't stop winning, right? Like it's insane. What gets everyone, and certainly has gotten me, is you kind of look at it and go, you know, even on that increased profit number, it's on 127 as a PE.
Yeah.
Like, that's up there, right? That's up there. So the comment I made was that you never want to be fussy on a really, really high quality company, but there is a limit, right? So again, this is not a valuation, but this is a what if. And you can do things like this. You could say, well, let's say they've grown at, what did I say? The CAGR on EPS over the last 5 years has been 35%. So it's off a smaller base. Let's say they do 25% per annum over the next 10 years. And bear in mind, the market opportunity is sufficient for that at least to be possible. And they've talked about going into new areas, adjacencies, and there is actually legitimate AI applications and all this other kind of stuff. So they could do it. They could do that. And that would only get them to, I think it gets them their profit to, oh gosh, I didn't write it down anywhere, but nothing that's sort of like out of the ordinary, right? It doesn't make it bigger than the GDP of California or something when you start compounding large numbers. And then if you put them on a PE of 35, so CSL trades on something like that as a high quality health tech sort of companies. It's not stupid to do that. You could do that and you could buy it today and get a 10% compounded return, excluding dividends.
Yeah.
That's doable. And then you could say, well, actually, what if I just extrapolate 35% growth? You know, again, it's not impossible. And you get the same PE. Well, now I've got an 18% compound return. And that would be an NPAT of 1.2 billion in the year 2032, which again, for a company that's very deeply embedded in every major hospital around the world, like, yeah, that seems plausible. So the comment I will make is that it looks crazy expensive. It might not be, but there is, I think we can all agree, a lot of optimism built into it.
Do you think you'd be tempted to buy here based on what you're saying though? Because you're kind of open thinking it sounded expensive, but it actually, from what you're saying, maybe not so expensive if you can. Or is it more that it's pricing in a lot of that assumption that, you know? You
mentioned Mike before. I think he made a comment on Strawman, which is like, so I did buy some in COVID. You know what? I am the worst market timer in the world, but I picked some up for $15 something in COVID because like really when things were getting dark. And so I wouldn't pretend that I can time anything, but I do know that markets go through ups and downs. And this is one that is just absolutely on the top of the wish list. And I'm not waiting for it to get to a PE of 15 because that ain't never going to happen. Yeah. But I think that you may get a better opportunity in the future. The other thing that I really got to disclose here is that my thinking is so muddied with the experience I've had as to not be rational at all because I have sold so much on the way up. I just look at it with you know bitterness and that's just so I'm not a rational agent.
Yeah.
What do you think?
No, I think it's fair. It's just it reminds. It doesn't, I don't want to compare it to Appen, but there's a certain point where Appen was at $40 and people are like, well, it's actually cheap if it keeps growing at 35% a year. And, you know, it's reasonable. AI is a lot of demand, etc. And obviously very different. I'm not saying it's like that, but it is just, it is things can go very differently if it starts growing at 10% a year. I guess is probably the thing. Like those numbers all change pretty dramatically.
So look, there is a lot to say on it, and I think the best thing to do is just go to A Rich Life, and because Claude's got a super detailed article on it, and we won't do better than that. So yeah, go check that out.
Yeah, sounds good. Yeah, maybe we wrap it there, Andrew. We had a good chat. There's plenty more we'll chat through next week. Earnings coming through hot and fast. Until next time, thanks everyone very much for listening. If you have any thoughts, you can hit us up on Twitter at BabyGiantsPod. And yeah, thanks very much.
Yeah, thanks everyone.